If you're not familiar with candlesticks, you might literally consider watching this video from start to finish to discover the secret language that traders have been using for ages, and how you too, as a trader or an investor, can use it to make informed and accurate decisions in the financial markets. Yes, we're talking about candlestick patterns. Those colorful bars you see on stock charts, currency pairs, or on Bitcoin, they all have the same language which you are about to learn and master if you watch this entire video till the end. They're actually super intuitive and simple once you know what to look for. Think of them as little visual stories telling you about the battle between buyers and sellers. Let's get started. Story of Japanese candlestick charts begins in the 18th century with a Japanese rice trader named Munehisa Homma, born in 1724 and died in 1803. Homma was a successful rice merchant in Sakata, Japan, during a time when rice was not just a staple food, but also a form of currency and a traded commodity. The Dojima Rice Exchange in Osaka, established in 1697, became the world's first futures market, where rice was bought and sold for future delivery. This setting provided a fertile ground for Homma to develop his trading techniques. To better understand the emotions driving the rice market and the behavior of traders, Homma began recording price movements. He created candlestick charts to represent these price changes, using the shape and color of the candlesticks to show the relationship between the opening, closing, high, and low prices over a given time period. Each candlestick consists of body, represents the range between the opening and closing prices. Wicks, or shadows, indicate the high and low prices during the trading period. Color. Typically, a filled or red candle signifies a drop in price, closing lower than the opening, while an empty or green candle indicates a rise, closing higher than the opening. At its heart, a single candlestick represents the price action of an asset over a specific period. It could be a minute, an hour, a day, or even a week. Each part of the candlestick gives us crucial information. The upper wick shows the highest price reached during that period, and the lower wick shows the lowest price. Now, the color of the body is key to understand the price moves. Typically, a green or white body means it was a bullish period. The closing price was higher than the opening price. That suggests buying pressure. Conversely, a red or black body indicates a bearish period. The closing price was lower than the opening price. That signals selling pressure. Looking at a series of candlesticks together can reveal trends and potential turning points in the market. That's where candlestick patterns come in. These are specific formations of one or more candlesticks that traders use to make predictions about future price movements. Let's start with a simple but powerful one, the Marubozu. This candlestick has a very long body and virtually no wicks. A bullish Marubozu, long green body, suggests strong buying interest from start to finish. It can indicate the beginning of an upward trend or the continuation of one. A bearish Marubozu, long red body, shows strong selling pressure throughout the period. It can signal the start of a downtrend or its continuation. Next up, we have the doji. This is a really interesting one because it has a very small body, meaning the opening and closing prices were almost the same. The wicks can vary in length. A doji often indicates indecision in the market, a balance between buying and selling forces. Depending on the context and the length of the wicks, it can sometimes signal a potential reversal of the current trend. For example, a dragonfly doji, long lower wick, small body at the top. after a downtrend can suggest buyers are stepping in. A gravestone doji, long upper wick, small body at the bottom, after an uptrend might indicate sellers are taking control. A long-legged doji with long wicks on both sides shows significant volatility and uncertainty. Similar to the doji, spinning tops have small bodies, but they do have noticeable upper and lower wicks. They also suggest indecision in the market. Neither buyers nor sellers are clearly in control. These often appear during periods of consolidation. Now, let's look at two patterns that look identical but have very different implications depending on where they appear in a trend: the hammer and the hanging man. Both have a small body at the upper end and a long lower wick, at least twice the length of the body, with little or no upper wick. A hammer appears at the end of a downtrend. The long lower wick suggests that although there was selling pressure during the period, buyers eventually stepped in and pushed the price back up near the opening. This can signal a potential bullish reversal. The hanging man, on the other hand, appears at the end of an uptrend. While it looks the same as a hammer, its appearance after a period of rising prices suggests that there might be significant selling pressure emerging, potentially signaling a bearish reversal. We also have the inverted hammer and the shooting star, which are mirror images of the hammer and hanging man. They have small bodies at the lower end and long upper wicks. An inverted hammer appears at the end of a downtrend. The long upper wick shows that buyers tried to push the price higher, but sellers eventually brought it back down. However, the fact that buyers were able to push the price up at all can be a bullish sign, potentially leading to a reversal. The shooting star appears at the end of an uptrend. The long upper wick indicates that buyers initially pushed the price higher, but then strong selling pressure pushed it back down near the opening. This can be a bearish signal, suggesting a potential downward reversal. Let's talk about engulfing patterns, which are two candlestick patterns. The first one is the bullish engulfing pattern, which appears after a downtrend. A small bearish candlestick is followed by a larger bullish candlestick that completely engulfs its body. This indicates that buying pressure has taken over and can signal a potential uptrend. And the second one is the bearish engulfing pattern. It occurs after an uptrend. It consists of a small bullish, green or white, candlestick, followed by a larger bearish, red or black candlestick that completely engulfs the body of the previous candlestick. It's the opposite of the bullish engulfing pattern, and this suggests that selling pressure has overwhelmed buying pressure and can signal a potential downtrend. Here are another two candlestick reversal patterns to be aware of. The first is the dark cloud cover, which forms after an uptrend. It consists of two candlesticks. The first candlestick is bullish. The second candlestick opens above the high of the first, but then closes significantly below the midpoint of the first candlestick's body. This suggests that the bullish momentum is fading and a bearish reversal might be on the horizon. The second pattern is the piercing line, which appears after a downtrend. The first candlestick is bearish. The second candlestick opens below the low of the first, but then closes above the midpoint of the first candlestick's body. This indicates that buyers are stepping in and could lead to a bullish reversal. Now, let's look at another pattern called the morning star. The morning star is the bullish counterpart, forming after a downtrend. It includes a large bearish candlestick, followed by a small bodied candlestick that gaps below the first, and then a large bullish candlestick that closes significantly into the body of the first candlestick. This pattern suggests a potential upward reversal. The opposite pattern of the morning start is the evening star pattern. Contrary to the morning star, the evening star is a bearish reversal pattern that forms after an uptrend. It consists of a large bullish candlestick followed by a small-bodied candlestick, which can be bullish or bearish, that gaps above the first, and then a large bearish candlestick that closes significantly into the body of the first candlestick. It signals a potential end to the uptrend. Let's now introduce you to two other candlestick patterns: 3 white soldiers and 3 black crows patterns. These are strong continuation patterns. The 3 white soldiers pattern appears during an uptrend. It consists of 3 consecutive long, bullish candlesticks that close progressively higher, with small or no upper wicks. This indicates strong and sustained buying pressure. The 3 black crows pattern appears during a downtrend. It's made up of 3 consecutive long bearish candlesticks that close progressively lower, with small or no lower wicks. This signals strong and persistent selling pressure. Now, before you rush off to trade based on every candlestick you see, it's crucial to remember a few things. Number 1, market context. Context is the most important thing in trading. A single candlestick or pattern doesn't tell the whole story. Always consider the overall trend, support and resistance levels, and other technical indicators. A bullish engulfing pattern, for instance, is more reliable if it occurs at a known support level after a downtrend. Number 2, look for confirmation. Confirmation is important. Don't act solely on a candlestick pattern without 2 or multiple confirmations. Look for confirmation from other indicators or subsequent price action. For example, after seeing a hammer, wait for the next candlestick to close above the hammer's body to confirm the bullish reversal. Number 3, practice and develop your patience. Practice and patience are essential while wanting to be a trader. Learning to identify and interpret candlestick patterns takes time and practice. Use a demo account to test your knowledge before risking real money in financial markets. Number 4, no pattern is foolproof. You have to understand that no pattern is foolproof. Candlestick patterns provide probabilities, not guarantees. Be prepared for patterns to fail and always use appropriate risk management techniques like stop-loss orders to always protect your capital. And now you have it, your beginner's guide to understanding candlestick patterns. This is just the tip of the iceberg, but it gives you a solid foundation to start analyzing price action charts. Check the description below to see other tools and resources we have for you. If you found this video helpful, there's just 2 ways you can help this channel. Give it a thumbs up and let me know in the comments below what you think the next video should be about. Happy trading, love you, and love trading.